Assalamualaikum and hello everyone. Today our group will discuss an important issue related to Islamic financial system, which is the issue of riba and then conventional loan and how Islamic finance offer ethical and fair alternative.
This issue is relevant to many people because we use financial products almost every day, whether it is for education, vehicles, even credit cards. Understanding riba is very important because it affects the fairness and stability of our economy.
So what is riba? Riba can be simply defined as any guaranteed or predetermined interest on a loan. In other words, if someone borrows money and then they are required to pay back more than what they borrowed simply because of the time, that extra amount is riba. Let's take one example. If you borrow 1,000 ringgit and then you must repay back 1,200 ringgit, that extra amount 2,000 ringgit is riba. Riba is not allowed in Islam because it involves a credit. The lender receives more money just because they lend it without taking any risk. Islam encourages fairness and justice. Any transaction where one side benefits unfairly at the expense of the other is considered harmful.
Next, type of riba. Scholars usually divide riba into two major types. Firstly, riba al-nasiyah. This is the most common types today. This refers to interest charge on loans. This happens when repayment is delayed or when a fixed percentage is added. Secondly, riba al-fard. This happens by the of exchange, especially when trading two similar items in unequal amounts. For example, exchanging 1 kilogram of wheat for 2 kilogram of wheat. Most modern banking interest falls under riba al-nasiyah, which is strictly prohibited.
Okay, next, how conventional finance uses riba. In the conventional financial system, interest is the foundation of almost every loan. This includes credit cards, personal financing, housing loans, car loans, education loans, and overdrafts. All of these financial products charge interest, which can increase over time depending on factors such as inflation, market rates, or bank policies. This situation creates several problems, including borrowers having to pay double or even triple the original loan amount. Many people also become trapped in long-term debt, while lenders earn money without sharing any risk. As a result, the gap between the rich and the poor continues to widen. Therefore, interest-based financing not only causes personal hardship but also negative effects society and the overall economy. Did you know why Islam prohibits riba? There are several reasons why Islam strictly prohibits riba. The first one is it causes injustice. Riba forces the borrower to bear all the financial risks, while the lender earns profit without effort or share responsibility. This violates the Islamic principle of fairness, where gain should come from genuine contribution and mutual risk. Second, it leads to financial exploitation. Those in urgent need often become trapped in high-interest loans, allowing lenders to profit from others' hardship. This exploitation contradicts Islam's emphasis on compassion and protecting the vulnerable. Third, it increases poverty. High and compounding interest makes it nearly impossible for borrowers to escape debt. Instead of providing relief, riba drains resources from the poor, widening wealth gaps and deepening poverty. The last one is it harms economic stability. Economies reliant on interest encourage excessive debt and speculation, leading to instability and crises when rates rise. Islam promotes a system based on real growth and shared responsibility, not financial pressure. Hence, Islam calls for an economic system built on justice, cooperation, and ethical exchange. As Allah states in the Quran, Allah has permitted trade and has forbidden interest. It is making clear that while fair trade is allowed, riba is strictly prohibited.
To solve the issues of riba, Islamic finance introduces alternative contracts that avoid interest and ensure fairness. Here are the main ones. First, murabaha. This is a cost plus sale. The bank buys an item such as a car or equipment and then sell it to the customer at a profit. The profit is fixed, clear and agreed at the beginning. It is not based on interest. Second, ijarah. This is leasing. Instead of borrowing money to buy an asset, the customer rents it from the bank. The payments are for usage, not interest.
Third, mudarabah is profit sharing. The bank provide capital while the customer provide skills. Both share profit and loss are borne by the bank unless due to negligence. Fourth, musyarakah, partnership. Both parties contribute capital and share profit at losses. Fifth, tawaruk, used by Islamic banks to provide cash financing without interest. All these contracts ensure that risk is shared and there is no predetermined increase like a conventional interest.
Next, to make it easier to understand, here is a simple comparison. Conventional loan, borrow RM1,000 and then repay to RM1,200 or more due to the interest. The interest is guaranteed even if you are struggling. Islamic murabahah, bank buys an item worth RM1,000 and then sell to the customer for RM1,200. As part of the sale agreement, the profit is halal because it comes from trade, not from lending money. This shows how Islamic finance avoids exploitation.
In conclusion, the issue of riba is central in Islamic finance because it influences fairness, justice and the well-being of society. Islamic finance offer better alternatives to contracts like murabahah, ijarah, mudarabah and musyarakah, which avoid riba and promote ethical finance practice. By understanding these concepts, we can appreciate how Islamic finance protects consumer and support a more just economic system. Thank you.